keeping software-defined vehicles digitally relevant for the years to come by decoupling previously integrated software and hardware. Our full-stride cloud service has had, I must say, an impressive year since its launch in June 2021. Our cloud ecosystem, from a revenue standpoint, grew at an accelerated pace of over 31% in the fiscal year 2022. On the M&A front now, we have continued to pursue strategic fits aggressively. Our more recent acquisitions, in particular Capco, are performing very well. We are very pleased to report that Capco has had a healthy double-digit growth this year. They're ahead of plan, and together we've had over 60 synergy wins across markets. As most of you will know, we have announced 2 more acquisitions in the last few days. The first one is Convergence Acceleration Solutions, or CAS. They are a US-based consulting and program management company specialized in the communications sector. They specialize in driving large-scale business and technology transformation. CAS Group deep client relationship and strong domain expertise, combined with Wipro execution capabilities, will deliver an end-to-end professional services solution and immediate impact on clients. We can now provide our clients with service ranging from strategy development and planning to execution and implementation. The second acquisition that we announced just earlier this week is Rising, a global SAP consulting firm. As one of the leading strategic partners in the world for SAP, Rising will become a critical extension of Wipro's SAP cloud practice and Wipro full-stride cloud services. Onto the operating margins now. We delivered profitability of 17% in Q4, adjusted for Capco, our largest acquisition. This will be well above the pre-pandemic margins levels. I will now provide some finer details on markets, service offerings, and sectors. All our markets grew double-digit, but the Americas and Europe, our top 2 markets, grew at 28% and 36% year-on-year respectively in Q4, and 26% and 39% year-on-year in the fiscal year 22. In Americas 1, we grew 22% year-on-year in Q4, with all sectors showing strong growth. For the full year, we grew 21% year-on-year. Communications, media, and information services grew 28%. Consumer goods and life science grew 26%. Healthcare and medical devices grew 17%, while technology products and platforms grew 34% year-on-year in the quarter. In Americas 2 now, we grew 34% year-on-year in Q4 and 30% in the fiscal year 22. There was broad-based double-digit growth across all sectors in the quarter. The order booking in terms of annual contract value grew over 56% year-on-year in Q4. Now looking at Europe, our European business has delivered an outstanding year-on-year growth of 36% in Q4 and 39% for the full year. Germany and Southern Europe have grown over 1.5 times in size. Benelux grew 23%, and our UK business grew 39% year-on-year. Our APMEA market grew at 14% year-on-year in Q4 and 9% in the fiscal year 22. Australia, New Zealand, Southeast Asia are growing in double digits year-on-year for the quarter as well. The order booking in annual contract value terms are looking healthy. 22% year-on-year growth, Customer relationship remain top priority. You know that. Our top 5 customers grew 35% year-on-year. Our top 10 customers grew 34% year-on-year. In the last 12 months, we have added 8 customers over $100 million. We have added 10 customers in the more than 50 million bracket. Now, from a service offering standpoint, our Ideas global business line grew 39% year-on-year in Q4 and 35% in fiscal year 22. Most of the sub-practices showed a very healthy double-digit year-on-year growth, led by domain and consulting, which basically tripled in size. The engineering service business that grew 26% year-on-year in Q4, which is a compounded quarterly growth rate of 6% over the last 4 quarters. Our iCore global business line grew by 15% year-on-year in Q4 and 17% in the fiscal year 22. Most sub-practices grew in double digits on a year-on-year basis too. Digital operations and platforms led the growth with 18% year-on-year for the full year. I'm pleased to report that, in line with what I had shared with you last quarter, our quarterly annualized attrition rate have moderated by 500 basis points. We doubled our fresher intake for fiscal year 22 when compared to the previous year. Our plan is to double this again in fiscal year 23. We have decided to increase the frequency of promotion cycles for 70% of our colleagues in junior bands to a quarterly basis. Leadership oversight is now deeper. The presence of senior leadership in location outside of India has improved by 16 percentage points, closer to clients. It's also relevant to note that nearly 50% of our leadership hires have been in the growth office with Stephanie and in the customer-facing global account executives roles. This means we are strengthening our frontline and sales teams. Over the last 21 months, we have improved also our ethnic diversity in our senior leadership by 24 percentage points to always become more global. And our gender diversity in the lead and we continue to do business responsibly. In particular, the humanitarian crisis in Europe has had our attention. While we don't have any material exposure in the affected regions directly, many of our employees are in the neighboring countries and have personally joined relief efforts, providing food and shelter for thousands of displaced people. Our employees in Romania are volunteering to manage a dedicated helpline to support those in need. We have also created an employee donation program and matching it to the dollar, doubling the available funds. We've also partnered with Project Hope. Their emergency response team and European partners are providing critical medical supplies and assistance to refugees. I can confirm that Wipro will always stand by the principle of democracy, justice, and equality. Before I close, a word on outlook for the next quarter. We have guided for revenue growth of 1 to 3%, which will translate to a growth of 16 to 18% on a year-on-year basis in constant currency. While we don't provide an annual guidance, I want to confirm that we expect to grow in double digits for fiscal year 23 as well. Our margins, for the medium term, we hold the 17 to 17.5% band. However, for the next 2-3 quarters, we will see slightly lower margins. This is because of the investments we have made that I spoke to you about earlier. In summary, we are, as I said, pleased with the current business momentum, very optimistic of further strengthening this business going into the new financial year. All our key markets are growing on a year-on-year basis, and that is the solid foundation we are starting FY23 on. On that note, let me welcome Jatin for his comments on the financials. Thank you.
Thank you very much, Thierry. I have a few comments which are specific to financials. As you know, we had a fabulous year, 27.3% revenue growth, 17.7% operating margin, and an industry-leading competitive tax rate of 19.1%, which led us to deliver an EPS growth of 17%, which is a great EPS growth by any standard. Let me talk about cash flows. Not only we delivered a great profitability that converted into the cash during the year, our operating cash flow was 91% of our net income, and our free cash flow was 75% of our net income. Let me speak about Forex. As we exit the March 31st quarter, we had $3.5 billion of Forex hedges, and we delivered 75.91 in realization terms in quarter 4. As at the exit of the fiscal, we had sufficient strength on the balance sheet. We had $4.6 billion of gross cash and $2.6 billion of net cash. As Thierry mentioned in his remarks, we have guided for quarter 1 at 16 to 18% in year-on-year terms, which translates to 1 to 3% in sequential terms. And we'll be very happy to take your questions from here. Thank you.
Hello.
Please introduce yourself and go ahead and ask your question.
Yeah, hi. Hello. Hi. Thierry, hi, this is Ayushman from the Mint, and glad to see you finally.
Finally.
Yeah. So the guidance that you gave for Q1 of 1 to 3% is actually lower than the 2 to 4% that you guided for Q4. So could you explain that? That's first. And second is with regards to the Russia-Ukraine war, I mean, did you have any operations in Russia and have you moved out of there? But at the same time, do you continue to sort of expand in other East European nations? Thank you.
Okay, so thank you for those two questions. So the first one is, it's clear that, we've been guiding on 2 to 4% for several quarters. It doesn't mean, we're going to sustain this level necessarily every single quarter. You've seen with the best, if you look at the best performing companies in our industry, there is always a quarter that will be a little stronger than another. And it's not a reflection necessarily of the market. Certainly, it's not for us, right? The pipeline is the same, performance in sales is the same. So I think it's just, where we believe we are comfortable in terms of guidance. Your second point, which is about our position in the East Europe market, we have no operations in Russia. We have no operations in Ukraine. We have operations in neighboring countries like Poland, Romania. And so, therefore, if you like, we have people that are indirectly impacted, hence the commitment we feel we have versus those who are struggling. But from a business standpoint, it's not an impact at all for us. And yeah, you ask about expansion in Europe. It doesn't change at all our expansion in Europe, our strategy. We are focusing on the same market, and those markets are not impacted by the crisis.
One question to Stephanie, since you have flown all the way from France and for the first time. So when you say
US.
America.
Yeah, so as the Chief Growth Officer, I mean, how do you really, what's your strategy to bring growth, especially how do you plan to mine large deals? Yeah.
Thank you. I'm thrilled to be here with all of you today and to have spent a week in Bangalore with my colleagues, and it's been very energizing and exciting. From a growth perspective, Thierry spoke to our strategy, and I've shared in previous conversations, we continue to execute on our new sales operating model. We have our large deal teams in place in all markets now. We're working closely with our accounts on major client transformation initiatives to help them, existing and new clients. So we're very focused on originating opportunities. We also are spending a lot of time with our partners. That's a great channel for us, and we've seen some great success this year where they're bringing us to their clients to help them with their system implementations and cloud transformation. So I think we've got an exciting strategy. We're executing on it, and as a result, we're seeing good results and a very strong pipeline.
Thank you.
This is Swati from Money Control. Great to see both of you here. Thierry here. Hi. So I just have a couple of questions. One is again about margins. So margins has come below the market expectations. So with the travel opening up and obviously the war for talent situation we are seeing, what are the margin levers? I have two more, so I'll just go after Jatin.
Yep. Sure. So, if you look at our Q4 performance, and let me talk in that context, we have made a lot of investments. We acquired two very exciting businesses in the beginning of the quarter. If you see our utilization looks quite stable from Q3 to Q4. But you have to remember that in Q3 we lose a lot of utilization because of leave, and we have invested therefore that much more in capacity in the beginning of the year. So some of the investments will actually help us grow faster. So we have made that investment. If you see our offshore mix between Q3 and Q4 has improved by 2 percentage points, which is quite healthy. So it's a constant delicate dance, so to say, between making investments and making sure that we are realizing every dollar we can from efficiency. We know that travel and other spends will come back, but as I said, we have invested in capacity. We have levers like offshore mix. We have levers like pyramid. We have levers like automation. So there are tons of things that we can continue to deploy and work hard on to cover some of those investments that we'll need to make in FY23 too.
And my second question is about the large deal momentum. So we don't see a lot of large deals coming up, which was the norm, I think, few quarters back. So do you see them coming back, or will geopolitics have some kind of impact on these large deals, especially the Russia-Ukraine crisis and also inflation in the US?
I'll start, and you okay? I'll start, and you'll go ahead. The reality is that we didn't have a particular focus on large deals. Happens, and I've said it at that time when we won Metro and Estée Lauder. I mentioned at the time that we've closed those deals because clearly this is a focus for us, but we didn't have the engine yet. So over the last 9 months, we've been ramping up the engine, and we have it. So the engine I'm talking about is, Stephanie being, having, senior talent that are true big dealers, but also commercial, finance modelers, and so on. So, and it requires a very different strategy. That is in place. That has triggered already a generation of opportunities in the pipeline that we didn't have before. There was maybe 1 or 2 deals like that, but they were more one-offs than a systematic generation of opportunities. We have it now. Does it mean that we can close deals immediately? You know how things are with those large deals. The sales cycle is typically a little longer. But I'm very confident and comfortable with what I'm seeing, and I can tell you one thing. There is a greater attention to big deal than there has ever been before. And I know, because I've seen that in the past, this is how it's going to pay off. Stephanie?
I don't know what more I can add to that. It's we have seen we have been involved and are involved in some very large deals. We do see them slipping in terms of decision making with clients, and in some cases, they're looking at phasing those in or dividing them across multiple suppliers. So we're definitely seeing it in some in the market, but the efforts that we've put in place to build this team, to expand the mindset of our existing team, and to really think about, how we address our customers' transformations and help them overcome some of the bubbles that exist when you're investing in those kinds of transformations. And so it's a different approach and a different mindset and strategy. And so I think we'll have a bigger pipeline, which we do, and a more consistent approach to those types of opportunities. So I'm excited for 2023.
Just one word on hiring. So what is the fresher hiring, Saurabh, for FY22? 17,000 was what you had shared last quarter for FY22.
We ended with more than 19,000 for FY22. And as Thierry called out, we are looking at doubling this number for FY23.
Hi, this is Sai Ishwar from the Economic Times. So my first question for you, Thierry, is there have been a lot of analysts reports saying that in Europe, because of the geopolitical crisis, there could be second order impacts, not a first order, but in terms of delayed decision making, in terms of tech spends and deals. And now also, this will also spill over to the energy vertical. So are you seeing any pressures, especially in this pie here of energy plus Europe? And my second question is, in terms of deal wins, can you give the year-end figure? Because you've closed around $2.3 billion, but I just went through the previous presentations of last year. I'm just seeing, has it fallen year over year on year? And yeah, I'll ask the third question.
Okay, all right. So I'll take the first one and just, I'll ask Jatin to confirm the number. But, that was 30% growth year on year. The first question is, I try to be, obviously, reflect a little bit on your question. It's difficult to know, honestly, the implications of what's going on in Europe. It's been only, 45 days. So it's difficult to know. What I know, I keep seeing, 3-4 clients every single day. So that's my biggest pulse. This plus the evolution of our pipeline tells me what's going on in the market. It's always, I've always worked like that. Our clients are not slowing down. I'm not seeing it, right? There are possibly some markets that will be more impacted, we know. I mean, the oil price will, and the gas are creating some tension, there's no doubt. There might be, among the investment of our clients, a bigger focus on cost, takeout and productivity gain, where we were rather well positioned as well. But, I stay focused. I'm looking at, what the market is telling us. For the time being, no sign. I don't see the pipeline going down, certainly. We haven't had more difficulty to close deals at the end of the last quarter. Let's continue to see how things are going.
Okay. So, I'll share one perspective. I think we are all very focused on large deal numbers, but if you look at from the context of the business which is walking in the door, you should look at all sorts of business which is walking in, because if you keep only one segment in mind, then you might make a mistake. So if you look at the total business that we have acquired this year, it has grown 30% year on year on an aggregate basis. And of course, the composition of whether there were, X number of larger deal versus mid-sized deal, that composition keeps on changing every year. And that has changed this year too. But I think on aggregate, we have got 30% year on year on ACV terms. The second point there is, as we exited quarter 4, we have exited a 38% growth, which means that we are exiting on a higher trajectory than the total for the year. So that also bodes well that business is actually in an acceleration mode as we are exiting. So we feel quite comfortable with what we have been able to win this year, and that's provided a sufficient sort of inventory to execute on as we start the new year.
Just my final question. Can you give the inorganic breakup in terms of 3.1% growth you've shown this quarter and also the guidance 1.3? Could you give the inorganic breakup?
Yeah. So we don't we don't share the for the acquisitions that has already been consummated. We shared the data when we acquired those. Those are available for you to make an assessment. But we don't break out the data because a lot of times when we post acquisition, we acquire business on either Wipro paper or an acquired company's paper. So it always becomes little difficult to segregate. What I can confirm is that 1 to 3% guidance that we have given does not include the rising acquisition that we have announced because it's likely to close by the end of the quarter, so we don't know when it will close.
Okay. Good evening. It's nice to see you all in person here. I'm Uma Kannan from the New Indian Express. You have been acquiring many companies with the recent one rising that you mentioned. Will this continue in this fiscal FY23, this inorganic growth, or are you also looking at organic growth? And my second question is on client spending. How do you see this client spending for this fiscal, and particularly in which vertical you're expecting it?
Okay, so first question is M&A. M&A is, we really drive two different tracks, okay? There is a absolute focus on the organic growth, and that will not change, okay? Our M&A strategy is actually not getting us focused on volume, on adding volume. It's really strategic. It is acquisitions that are complementing our set of offerings and really allowing us to have, a bigger play with our customers. Look at Capco, right? It transformed the way we can interact with banks and financial institutions. Rising, same thing in the SAP space. We suddenly have the opportunity to have a different type of discussion and drive end-to-end programs, starting from the design to the implementation. CAS, exactly the same thing. Agile, those companies are not big, by the way. They're rather modest in size, but they bring a fabulous addition of consulting capabilities, in some cases, or domain expertise to our offerings. So that's really the strategy, and it doesn't change. We don't have a number to hit for the year, right? So it's not like we have to get a certain volume of deals acquired. Absolutely not. We go for an acquisition when it makes sense from a strategic standpoint. That's only that is driving our decisions, and we will continue with the same approach.
And my other question on client spending.
I was going to come to the second one on client. It's a bit linked to the first point, first question from one of your colleagues. I think the clients, are still on the trajectory of 2022, frankly, of 21. I don't think I have seen a lot of clients that are suddenly slowing down investments or postponing these investments. I haven't seen it, right? In our set of accounts, I don't have in mind one client who would have tell us, okay, change in course, we are no more investing for the foreseeable future. And again, one of the things that I noticed over the last 2 years, and it's a difference from what it was before, is that we tend to be more on the solution side for the clients than on the problem side. We are more an option for them or a way to improve their productivity, and therefore we are not necessarily the first budget to cut. Now, I need to use this statement with a pinch of salt because, as I said, we need to continue to look at the evolution of the market and stay very, vigilant. As I said, manufacturing sector could potentially suffer from the oil price, right? And the pressure from East Europe. Let's see. For now, I don't see a change in pattern. I don't see a change of the market. And I continue to be positive. We continue to be quite positive about 2023.
Thank you. And my question is on attrition. Like, do you see this stabilizing in coming quarters? It's already like kind of settled now. So will this continue or how it will be?
You know, this question we've been answering for the last few quarters, and so very clearly there was a supply-demand gap. We saw heightened attrition. We have seen the first quarter where the attrition in quarter has come down by more than 500 basis points. But the pressure continues. You know, the demand is robust, as we are hearing from Thierry. Pressure continues. We see that it will be flat, but we have to continuously work on this. But whilst I say that, I want to re-emphasize that supply side's situation is robust and not impact demand, at least for us. We have enough inventory. We have hired a lot of freshers. We have hired laterally. We have enough inventory to manage all our demand requirements. So that will not be a challenge for us.
Thank you.
So we're streaming live on our website, and I have a question from Shivani of BS. I'll read it out. What will be the hiring target for FY23? And Thierry mentioned that 70% of junior associates will get promotions quarterly basis. What are the other measures for bringing attrition down?
So hiring targets we don't give. We have given a target for freshers. As you said, we're looking at 2x of what we've done in this fiscal. From a lateral hiring perspective, it is demand-driven. It is robust across the globe, across the technologies which we need to hire from. So there is no target. Depending on demand, we'll continue to hire. As far as, given that we want more growth for our people, freshers, we have done this promotion on a quarterly basis. That's a big shift for us. So we feel that will engage our people. They've also rolled out two things from a fresher standpoint. One is, as we onboard those large numbers, we have given them a clear career and path to them, both from their compensation and career standpoint for the next 5 years, which I think is part of their contract. It's very visible to them, so they know how they can manage that. And second is, we have launched a very clear industry first, where we have engaging with the partners to train these freshers prior to their joining to become full stack engineers as they come on board. And when they come on board, they come out at a different salary level than they were hired. So it's fairly attractive for them. And that's the thing of building this as we move forward. Whilst the other aspects of engaging people, paying competitively, making sure they get the right work, upskilling them will continue. Any other questions, Purnima, online?
Yes, we have one from Romita for ET. How has local hiring in the US and Europe progressed? How far has it eased your dependency on H-1B visas?
So local hiring, in fact, I can say that nearly, if I take US and H-1B, 80% of our plus of our population in the US are locals. So I think it's completely eased off our pressure on H-1B. We will continue to move people based on skill and requirement, but it's all about building local capability. If I go to the non-English speaking countries in Europe, it's even far more. So I think that's the approach, that in the markets, grow with people who are from those markets. So I think that's what's playing out well for us.
An additional question from Romita, Economic Times. What is the return to work plan for FY23?
Return to work plan is, in theory, you would like to speak about this. You have a very passionate about it.
You're on a roll, I can see. What we are saying to our employees is, one, it's, we experience, I've gone to the office every day for the last 2 years, and I know some of us have done the same, and it feels good to see colleagues at the office. And so I've been encouraging over the last weeks our senior leaders to come regularly, if not always, at the office. With our employees, we understand that there is a demand on their side to keep a certain level of flexibility. Hybrid model is a model that they like. Does it mean that it's always going to be the case? I think we need to be very, we don't need to draw a conclusion too rapidly, because the reality is that the world has changed. 2 years has been long enough that people have taken new habits, and they like to work from home. But they also like to come to the office because they're missing their colleagues, they're missing the social connect with the rest of the team, and we encourage that. So a long story to answer to say that at the end of the day, we want the model to be hybrid. We encourage people to come to the office, but we also recognize the fact that if they prefer to work from home, they can. That's the hybrid environment we will probably live in at Wipro and in the industry.
Hi. Hi, everyone. This is Rishabh from Deccan Herald. If you look at the verticals, your manufacturing has gone up, but technology has come down. If we take year-on comparisons, what's the strategy there, and what do you expect in FY23? And my second question is, with respect to lateral hirings, how do you plan to compete with the startups, offering better facilities and lucrative offers?
No, they're not offering better offices.
Okay.
No. So let me take the two questions, but I'll start with the second one. The competition with startups is not new. We've had that for several years. And I think that, I'm connecting every week with very junior members of the team, in one-on-one interaction. They love, the spirit and the culture and the uniqueness, frankly, of the culture of Wipro. So I think this competition exists. I absolutely respect, the startups, but also the large other companies, the hyperscalers. There's plenty of company in the technology space, in particular in India, but not only in America, in Europe, and so on. But I think we have a good attractiveness. I believe our attractiveness has increased over the last quarters. Your first point was on sectors, manufacturing and technology. So again, I'll ask Jatin to keep me honest, but I think our technology business continues to grow very well. So you might have, again, those are sectors where, depending on the life of one account, one quarter, you might have up and down, but it is a sector that is growing well and very pleased about the outlook for 23. Manufacturing was a sector where we were rather small. It's a modest size. So obviously the volatility of this sector is bigger. Having said that, we've had, we are only accelerating. So I'm actually very positive. We've done great things, for example, in the automotive sector. We talked earlier, I spoke about software-defined vehicle. And this is getting a lot of traction because obviously it's connecting with, the top priorities of car manufacturing and OEMs for the years to come. We are really not into the traditional IT space. We are really where, their industry is going around electrified vehicles and software, embedded software in cars. So I'm also quite positive about this manufacturing sector.
Thank you.
We have one more question from Bisma Malik, Business Today. Do you see a trend emerging of a shift in IT talent base to India since Ukraine was emerging as a talent hub lately?
I'll try this one, Saurabh, and you can take it. I don't know if there is a shift. I mean, India is the heart of technology in the whole world. So it's not new, and it will continue. Right? There's no better country in terms of talent, in terms of potential, than the Indian market for our industry, and it will continue. I've said it for several years already. There's no way it will change anytime soon. But you're right that it cannot be the only country. Our clients expect us to have, different options. And, Ukraine was a particularly important, Ukraine, Belarus, Russia were important markets, especially for, software engineering world, right? And I think obviously this, at the moment, it's a terrible situation for this industry. And it just reminds us that, it's important to look at, the overall political environment and make sure that we are able to adjust and shift talent from one place to another. And that's why we need to have centers. We do have, very important centers outside of India, like the Philippines, like, Romania, to name a few. And we'll continue to develop these centers, absolutely. So you cannot be just focused on one single market. Our growth and the expectation of our clients require from us that we continue to expand in other places as well. One more? It feels like, so new to have a real audience and see some real people that I wanted to continue.
Hey, good evening, team. My name is Akhil. So first of all, congratulations for completing 10 billion mark in revenue. So my question is on inflation. So we know, inflation is picking up in India and across geos like America. So do you sense any cut in client spending? And if yes, then what's the strategy for Wipro?
You want to take that one, Jatin?
Traditionally we have seen that if there is a flexibility in the P&L, customer goes for transformation and discretionary spend. If there is a certain amount of intensity or stress in the P&L, then we tend to benefit because we can provide very competitive high-end solutions to our customers. So frankly, we don't see a challenge because of in terms of the type of or volume of work that could come to us. Yes, the type could change. Also, please be mindful that some of this is driven by a certain amount of current situation, and that could change few months down the line as some of the central banks can take certain steps. But by and large, we have not seen any impact, and we feel quite, as Thierry mentioned, that our interaction with the customer remains quite positive around the demand scenario, so we feel quite good about it.
We've completely run out of time now. We'll have to close the press conference. Thank you so much for attending. It's nice, lovely to see you all.
Thank you.